Hello friends, we are finally getting to a stage where we can analyze the financials of our lemonade stand. As you can see on the screen, we have three financial statements for 2 weeks that we prepared in the previous videos, and now we can analyze these financials. So first we want to adjust our financial statements to make them more usable for our banking purposes. I'm starting with the income statement. And what we want to do is combine week 1 and week 2 to get income statement for 2 weeks. And it's quite simple to do. We just add line by line week 1 with week 2 and we get income statement for 2 weeks. Next, I want to adjust the income statement to show EBITDA figure separately. EBITDA is earnings before interest, taxes, depreciation and amortization, and it is a quite important figure to bankers. And why we want to show depreciation and amortization expense separately is because, as you remember, this expense is accounting expense. So our fixed assets got older during the first 2 weeks and we recorded depreciation expense. But in reality, the businesses will more likely prioritize debt obligations before they decide to make improvements or maintenance of their fixed assets. So in our case, EBITDA represents accounting income available for debt service. And there is a correlation. The higher the EBITDA, the higher loan amounts the business can service comfortably. So to get the second income statement, it is quite simple. In cost of goods sold, if you remember, we had depreciation and amortization expense of $10 each week. So for 2 weeks we have $20 of depreciation and we take it out from cost of goods sold and show it separately after EBITDA. And after depreciation and amortization we have EBIT figure, which is earnings before interest and taxes. And after that our income statement is similar to the one we had before. And we have similar net profit of $48. So quite straightforward to do. We got our income statement and now we need to deal with the cash flow statement. Similar with the income statement, we just need to line by line add week 1 with week 2 and get our cash flow statement for 2 weeks. This is what we did here, and now our financial statements are ready. So let's imagine that we got these financials from the business and need to do a quick screen of financials to decide if it is a potential client for us or not. So I would be looking at 4 things: sustainable profit, leverage, liquidity, and accounting income versus cash generation. Let's look at them one by one. So sustainable profit. The first thing I will do when I receive financial statements, I'm going to the income statement, to the bottom line, and want to see if the company is profitable or not. And then I would look at revenue. Is it stable or growing compared to previous periods? So of course, ideally we want to see stable or growing revenue. So if our revenue is declining, it would be a yellow flag that we need to look into. And I would look at margins. So we have gross margin, which is gross profit divided by revenue. In our case, it's 27.9%. And we would look at EBITDA margin, which is again EBITDA over revenue. And we have 15.3% of EBITDA margin. And I would compare these margins with previous periods to again look if our margins are stable or increasing. That would be a good sign and would indicate that the company has a strong position in the industry. And again, if the EBITDA margin is declining, that would indicate some problems and we again would need to look into this. Second is leverage. So first ratio I would look at is debt to equity. We would compare liabilities with equity, and in our case it's 0.54, which is a good ratio. It would mean that we have more equity than liabilities, which is always good. And debt to EBITDA. So for example, if we have $2,000 of debt and we have annual EBITDA of 1,000, our debt to EBITDA figure is 2 times. And usually debt to EBITDA figure below 2.5 is considered acceptable. Let's have a look at extreme example. If we have $5,000 of debt and only $1,000 of annual EBITDA. With average maturity of 5 years, we need to make repayments of $1,000 each year. And if we also include interest payments, we have debt-related payments of $1,100 to $1,200 each year. And when we compare this to only $1,000 of EBITDA, we can see that we don't have enough EBITDA to cover our debt obligations. Next, we have liquidity. And in this case, I would look at current assets over current liabilities. And in our case, we have 1.9, and usually current ratio above 1.4 is considered acceptable. And that would mean we have more current assets than we have current liabilities, which is always a good sign. And finally, I would look at our accounting income conversion to cash. So in this case, I would look at EBITDA to operating cash flow conversion. So we have operating cash flow divided by EBITDA, which is $17 of operating cash flow divided by $85 of EBITDA. We have 20% conversion, which is quite low. And this is one of the weaknesses of this business. We have too many receivables, too many sales on credit, which results in low conversion of EBITDA to operating cash flow. Usually ratio above 60% would be considered acceptable, but in our case it is quite low. So now let's make conclusions. First, our company is very young. We only operated for 2 weeks. It is very early to say anything regarding this company. Second, we have too many sales on credit, and it is very unusual for this type of business. Let's imagine a lemonade stand, and I would imagine that all sales made by this lemonade stand are on cash. And in our case, a lot of sales are made on credit to our friends, and what is more concerning that a lot of our friends are not repaying. So as you remember, during the second week, only 15 out of 20 friends repaid to us. And for this type of business, we would expect our friends to repay on the same day or on the next day. And if they are not repaying only $3 after 1 week, that is quite concerning. Third is seasonality of the business. So if these 2 weeks are happening during the summer months, we can imagine that during the colder months, our revenue will decline significantly. And then I would look at repeat customers. If every week we have the same customers, it would mean that they love our product and that our revenue is quite sustainable. So that's it. I just wanted to say that if the company is not meeting any of the screening criteria, it doesn't mean that it is an immediate no-go. It just means that we have a yellow flag that we need to explore further. And in the next video, we will have a look at the public company and analyze their financials. And I think it will be very interesting. So I'll see you, and thanks.